If you think humans control the stock market, you're already losing. Not because you're careless, not because you ignored finance news, not because you failed to learn how money works, but because the system quietly changed while everyone was still arguing about the old version. Right now, at this exact moment, millions of trades are being executed, canceled, rerouted, rewritten, and replaced, faster than your brain can register a single conscious thought. Not seconds, not milliseconds, microseconds. A timescale so small that human decision-making simply doesn't exist there. No hesitation, no discussion, no fear, no greed, at least not in the emotional sense humans understand. Just machines reacting to other machines, competing over microscopic advantages that seem meaningless, until you realize those fractions of a cent compound into billions of dollars every single day. Human investors are no longer the drivers of the market. We are spectators, sometimes beneficiaries, often victims, almost never in control. And the most unsettling part isn't that this system exists, it's how quietly it took over. There was no announcement, no emergency meeting, no moment where regulators stood up and said, "From now on, humans will no longer be in charge." There was no single turning point, no dramatic takeover. Instead, control slipped away gradually, so slowly that no one panicked, and so efficiently that no one stopped it. Speed crept in first, then automation, then dependency, and by the time anyone realized what had happened, the system was already too fast to slow down. And yes, somehow, it gets worse. And funnier. In the kind of way that makes you laugh first and then feel deeply uncomfortable when you realize the joke is on you. Imagine waking up one morning and checking the market like you always do. Same phone, same app, same numbers. Same comforting illusion of control. There's no breaking news alert, no global emergency, no political shock. Everything appears normal. Then prices start behaving strangely. Stocks dip sharply, then rebound, then dip again. Charts flicker, numbers move too fast to track. What looks like volatility at first quickly becomes something else, something unnatural. Entire companies lose massive portions of their value in seconds, only to recover moments later as if reality itself briefly glitched. News anchors scramble for explanations they don't yet have. Analysts speak confidently while guessing. Traders stare at screens, frozen, because by the time they understand what's happening, the market has already moved on without them. Money doesn't slowly drain away, it vanishes. Confidence collapses. Trust evaporates. Panic spreads not among machines, but among humans watching machines do things they don't fully understand. Money behaves like it has a personal vendetta against everyone involved. Even economists panic, which is impressive because they're usually just confused in a slower, more academic way. This isn't hypothetical. This already happened. And it wasn't caused by fear, rumors, bad earnings, or bad news. It was caused by speed. The official story is clean, polished, and comforting. Markets today, we're told, are more efficient than ever. Algorithms provide liquidity. High-frequency trading narrows spreads. Machines remove emotion and stabilize prices. Information is absorbed instantly. Volatility is framed as a natural feature of a healthy system. And when something goes wrong, it's explained away as a glitch, a rare malfunction, an edge case. Nothing structural, nothing dangerous. Nothing that threatens the foundation. That explanation sounds reasonable as long as you stop thinking right there. Because the moment you zoom out, the contradictions become impossible to ignore. If markets are safer, why do crashes now happen faster than humans can react? If machines remove emotion, why does the market behave like it's permanently caffeinated and anxious? If humans still control the system, why does every major disruption feel unstoppable once it begins? The uncomfortable answer is simple. Control didn't disappear. It relocated. Modern financial markets are no longer driven by long-term investing, careful analysis, or patient capital. They're driven by speed. Not insight, not understanding, not wisdom. Speed. Trading firms spend billions of dollars to shave microseconds off transaction times, not milliseconds, microseconds. They build enormous data centers as close as physically possible to stock exchanges. They fight over physical distance. They dig straighter tunnels, lay shorter cables, optimize geography itself because even light has limits. And whoever hits those limits first wins. This isn't finance the way most people imagine it. This is physics with money attached. The algorithms running this system don't understand businesses. They don't know what a company produces. They don't care whether it creates long-term value or destroys it. They don't read balance sheets or listen to earnings calls. They react to signals, price movements, volume spikes, momentum shifts, many of which are created by other algorithms doing the exact same thing. Machines watching machines, reacting to reactions. Inside feedback loops so fast and so complex that no human can meaningfully intervene once they start. And once a system reaches that point, it stops behaving like a market. It starts behaving like a reflex. Warnings appeared early, flash crashes that resolved too quickly to investigate, liquidity that vanished precisely when markets needed it most, prices that looked stable on the surface until stress arrived and then disappeared completely. These weren't secrets. Regulators saw them, institutions saw them, the firms building these systems certainly saw them, but stopping the system would have required admitting an uncomfortable truth. This market wasn't designed for resilience. It was designed for profit. Short-term, hyper-optimized, machine-driven profit, it wasn't an accident waiting to happen. It was a ticking time bomb that everyone involved convinced themselves they could step away from before it exploded, like watching someone juggle knives while smiling and saying, "Relax, I've done this before." Then one afternoon shattered that illusion completely. On the 6th of May 2010, markets suddenly collapsed. Not gradually, not logically, instantly. In minutes, nearly $1 trillion in market value vanished. Stocks that were considered stable plunged to absurd prices. Some traded for a single cent. Others briefly soared to thousands of dollars, not because anything changed, but because the system lost coherence. Then almost mockingly, everything snapped back. This moment would later be known as the flash crash. There was no dramatic trigger, no catastrophic headline, just a large automated sell order entering a market already stretched thin by speed, leverage, and complexity. Algorithms detected falling prices and sold. Other algorithms detected selling pressure and sold faster. Liquidity providers withdrew. Buyers vanished. The market didn't crash. It evaporated. Humans tried to intervene, but by the time they understood what was happening, the machines had already completed the cycle. The collapse unfolded faster than human comprehension itself. Afterward, some trades were canceled, losses were quietly adjusted, explanations were issued, official statements reassured the public. The system rebooted and carried on. On paper, everything was fine, but something fundamental broke that day. Because the flash crash exposed a terrifying reality. The market wasn't just volatile, it was brittle, stable under normal conditions, fragile under stress, efficient until it suddenly wasn't. Some experts argue this wasn't even a crisis, it was a transfer. The fastest players survived, the slowest absorbed the damage, and the system quietly rewarded the very behavior that caused the chaos. If money could scream, that was the moment it would have lost its voice. And the most important consequence wasn't the crash itself, it was what came after. Algorithmic trading didn't retreat, it expanded. Markets became faster, more complex, and more opaque. Speed became more valuable than understanding. Complexity replaced transparency. Risk didn't disappear, it became harder to see, easier to ignore, and easier to deny. The average investor didn't gain protection from this evolution. They gained exposure. Exposure to systems they can't see, can't understand, and can't react to in time. Retirement funds, pensions, savings accounts all quietly tied to markets governed by machines operating on timescales humans don't exist in. This affects you even if you've never traded a stock. Because prices don't just affect investors, they affect jobs, wages, rent, inflation, the cost of living. When markets become unstable, the consequences ripple outward, slowly, invisibly, and relentlessly. When prices are set by machines reacting to machines, stability becomes an illusion. Everything appears fine until stress appears. And when it does, there's no pause button, no human override, just automated momentum amplifying itself until something breaks. The real lesson here isn't about code, it's about behavior. Finance isn't numbers. It's human psychology scaled up, automated, and weaponized. We built machines to remove emotion, then rewarded them for exploiting emotion faster than humans ever could. Money isn't the real problem. People are. Every financial crisis teaches the same lesson. Greed wins the short game and destroys the long one. And if this story feels unsettling, That's because this wasn't the end. It was only the warm-up. The system that controls markets today is faster, more complex, and more automated than ever before. The algorithms are smarter, the feedback loops are tighter, the margin for error is thinner, and the next time something snaps, it won't wait for humans to catch up.